Hey everybody, should have UCAT up here right now, which I've got a lot of confluence in thinking that we're going to be bearish today. So I want to see us close over the open price. There are lots of things to kind of look at. ES, expect, depending on how quick we get, expect us to reject off this NWOG, going from NWOG to NWOG. Uh, NQ, I've got a few levels here that I have marked out. We're getting over this. These are some high time frame levels. We're getting over the event horizon. So when we look at levels, we like to look at NDOGs, NWOGs, event horizons, checking out the dollar. One thing I want to mention within your settings, which I think is extremely important, and within your onboarding, you need to know what your framework is with what indicators you're using. The number one indicator, what's most important, is going to be your drive, right? I like utilizing and extending it forward because, well, because KM7 plays out quite beautifully when maybe you're not looking at the exact level from the specific session, but you include the imbalance as well as the DR as a specific level. So a few things I want to go over with you quickly. It's kind of housekeeping. I'm not in a massive rush to say, hey, we have to take a trade. Although I do like this CAD, and I am kind of waiting on some bearish vibes to potentially go short. ICT everything is a new one that I've kind of added as far as an indicator goes. These projected levels coming off of the flout, I find extremely powerful. So ICT everything is one. Your M drive, your M7 drive, your NDOG, your NWOG. These implied fair value gaps I think are decent. I like those a lot. I project price off of market structure. So intermediate term highs, highs and lows, intermediate term lows, intermediate term highs, I find extremely beneficial. So there are a stack of indicators, not that I'm trading so much off of the indicators, but I am utilizing them as easy framework. So getting back to the dollar though, and where and how the KM7 model played out, and where you might not see it. Here, let me double check and make sure in the chat that we're okay. You guys can hear me all right. You can see me all right. Any comments would be advantageous, beneficial. I appreciate it. Yes, good. I don't have to focus so much on that. But extending your ADR, ODR lines to the end of the most recent RDR, if you don't have that, and we go back and we look at this, you can see where or how maybe it doesn't look like the KM7 model would play out. But my goal is to have a singular focus for you guys and a single model that you can rely on, that you can bank, or better said, take to the bank in regards to finding consistency and profitability. There are many models out there, many models. But we're going to focus on one. We're going to focus on a simple rule set. And where and how I introduced the KM7 model last week, this week, the only caveat, the real caveat, is I want you to look at the daily within the model, and where and how the Asian levels are going to play into the London levels, are going to play into where and how the New York levels are going to come into play, both statistically as well as within the data. So to me, that's very important. And within looking at a projected level, for example, come on, my gravity, my gravity fib. I want to see more or less where we're at in relationship to projection. So I utilize the DR and the IDR within projections. It's easy to key off, and I mentioned this to Iris, who was asking. External ranges, I like to key off of the IDR. So when we're talking about things outside of the range, I like to key them off of the IDR, which is going to be just the open and the close, the high and the low within this algorithmic time frame, or better said, time-based cycle that occurs every day, 3 times a day. And then within that, if we have extended past it, what I typically do is I utilize the doubling sequence just to look at levels, examine our 4 standard deviations. So this is not a panacea. There's no hidden answers that you might be searching for, but what they are predictions, framework for projections, more importantly, right? Talking about projections, and then we want to see where and how these levels act as the classic support and resistance. So I'll put this here. We're staring at the dollar. The dollar is a non-tradable asset for most of us, but it gives you a very reliable framework on other things that are happening. And as we wait another 20 minutes for the DR to actually close, it's good to look at, good to study, good to analyze a few of these other things. Now, I will be periodically looking in the chat if you have a question. We're on the stage, so it should be easier audio-wise for you to hear without so many distractions. But I like looking at these levels, again, for like a support and resistance to see if I feel like I'm on side with what these levels are projecting, right? So the dollar's gone far more past the 2.5 within its standard projection. Something else I recommend is we analyze things on a 5-minute chart. We also want to look at a 90-minute cycle. And what do we see on a 90-minute cycle as far as where terminus could be if we were utilizing projections coming off of an algorithmic level, and then we far exceed what those projections might be? The easy answer, and what I want you to remember for your notes, is that you utilize a doubling sequence. So these fractals are ever expanding, and when they expand both 4 standard deviations as well as double, depending on the time frame. So 30 minutes is where you're going to get the best level within the drive, which for now is really all we're looking at. But within looking at that, what do we see here in the way of standard deviations? We see Tuesday's price, and we see some levels here. Now, they're very light and faint within my settings. This is how I prefer to see the standard deviations. And again, I do want to go over what I feel are good settings for your indicators. Indicators are tools. Tools are going to provide framework. Framework are going to help you make your decisions. General settings, you can turn off any one of these, and at times it might sound counterintuitive, but I might only be looking at the after hours or the Asian session in regards to what's happening in London because of the DR levels, because of the data, and because of the information that's provided previously to anticipate what's going to happen next. I also highly recommend within your rule set and your models that you really look at extending these levels, because you'll find that the open and the close, that your trigger line are going to play within your anticipated production or prediction. So you can play around with any of these and turning them on or off to make life easier in your general settings. I do highly recommend that you incorporate these things and that you extend these things as you see them. Now, I have previously suggested standard deviations dynamic and auto, but I like the static and I like the 5 because it gives us a 2.5 level, which Captain Matt Mickey and I have studied and found a very interesting correlation with the 2.5 standard. So keep that in mind. Your RDR standard deviation levels, extending those. When you have specific data, you can click extra, and if you believe it's going to be more based on your analysis of lens, then I would highly recommend that you incorporate those additional levels within your analysis of the specific global session. So statistics, I have that box turned off, but within that box and within that calibration of that box, our setup, our very specific setup, has a 0% retracement off of the DR, so it should bounce off of the DR. Our invalidation point is just above the negative 0.333333333333 at 0.35. That is again from quite a bit of backtest and study, and I just give that to you to incorporate within the model. So continuing down, colors are a thing. Tiny standard deviations dotted at 1. I like the blue and the red. Your retracement grid level can also be tiny or small. Your retracement grid is the measurement within the range, and our standard deviations are a measurement outside of the range. Light gray. I like the light gray personally. It's a little easier on the eyes because it can get to be a lot of lines. My trigger line is green. My open and my close are red and blue. And then the fail line, setup target fail line, or the negative 3.5 retracement within the range, typically like that to be yellow. I like that to be solid. And I like to just utilize these primary colors, red, blue, green, and yellow, as visual identifiers within the range for specific things that I'm looking for. My box, bullish order flow, when the open is lower than the close, you get a blue box. When the open is above the close, you get a red box. This is an early indication, a probabilistic indication, not a panacea. Nothing we are doing within these algorithmic environments are 100%. You're looking to stack data and statistic probabilities within your analysis of price. So within doing that on a higher time frame, what do we see today specifically with the dollar? So we have a confirmation bias off of Asia, and then we come in and we touch the DR. That's what we want to see. And if you are studying and analyzing the dollar, it's going to give you framework for where the euro dollar is going, the exact opposite. So within looking at this imbalance here in this confirmation, and then we don't come and fill this with buy side, which I would potentially think we would, but we do play out the model pretty close to a tick, exactly as we would want to see or anticipate it to happen. And we have a framework for the dollar. We have these standard projections. We have a volume imbalance here untouched. We have a 0.5 standard deviation down here based on Tuesday's price. Quickly going to look at the CAD. I want to see us close below the open price. Like to see it hit the 4th standard of the flout. The central bank dealers range is right here. Asia is right here. The central bank dealers range, as well as Asia, as defined by ICT, create the flout. The flout is an advanced concept, but some of the best traders that I know utilize this advanced ICT concept to frame and create trade plans. So the ICT everything, I mean, I know a good friend of mine who only uses this one indicator, nothing else. So we've driven down a half standard. I'd want to see us come back to, there's this open price, potentially this open price for a model-based setup, and a retracement to tick off of this to then continue lower. If it doesn't happen, that's fine. Then the model doesn't play out on UCAD today. And we try and trade off rule sets and model-based trades. So euro dollar, I have some different framework on here. I'll teach you some of these eventually. As we get through the KM7 model, there'll be more things to look at. I have a few lines here that I've put on the chart that I find as being fascinating levels. Where is the M7 drive? Here it is. Looking at UCAD, We're at 1.5 standard deviations on yesterday's projected price. I've got my own levels and projections here within market structure. I'll explain market structure quickly. What had happened was we had a macro. We had the 850 macro come in to 910. Projected that out a little bit because I wanted to see where and how price reacted to that macro. It didn't do really much beyond, let me zoom out some of these levels here. You'll see I have some standard deviations of my own from what look like floating kind of fibs. Again, I'll definitely be teaching you guys this within our coursework. I'm not trying to overwhelm or confuse any of you within this process. We have a model to test and to back test and to utilize. So I zoom in and I want to see where and how these tell me that I'd like to see us hit this line and for price to retrace back into some of these lower ranges, some of these lower levels. Projected Tuesday's RDR price upward. I'm looking at very specific levels, but within the framework that we keyed up, just wanted to show you what this was, where and how price reacts to specific levels. I will be teaching you more, and I actually have a meeting with 2 degrees I'm working on. I have a few model-based indicators that could and should help within defining and refining a few of these rule sets, specifically where and how macros relate to our if-then statements. So these purple lines are macro levels, highs and lows on a low time frame. And again, I'm not going to get into that so much today in today's class, but they are things we are indeed looking at. On a 1-minute chart, I'll show you at the time of the analysis where these lines were put, we'd driven into a high and I instantly took the low that was there, and I wanted to see and create if-then statements towards price closing above this high for bias. And this red line is where I'd like to see price, if it were to turn around, where I'd like to see it turn around. So the if-then statements then get derived and driven based off of specific levels that are hit at very specific times. So when I find a high, a new high is created, I look at that first drive low and I create if-then statements. Why is this so slow? I feel like my computer's running at a slow rate. The 1 minute's going to tell us what the high time frame is going to do within market structure. And my highs and lows typically are blue and red. Try and keep it consistent. The only this line I guess should be blue too technically, as being a projected high that I'd like to see or am anticipating. But what I want you to do within looking at understanding framework, even though you see all these indicators on, I make financial decisions without indicators, utilize them as tools and framework. But that high is formed, this low is formed, and I want to see price close below, and it did, in ranging internal liquidity. I have specific concepts that I utilize within these flat candles. But again, we'll get into that on another day. Let's bring this here to what the original point of interest was on a low time frame. Looking at and reading and anticipating order flow within what we'd like to see as a high time frame objective hit. And on this very, very low time frame, we respected the macro level and we projected some price off of that macro level from the high and the low of the 850 to the 910 price. We took a previous macro's projection and this macro came and hit it. These were just levels here. We're looking at the euro dollar at the moment. Could be looking at really anything. 5 minutes. The euro dollar and the dollar have that inverse relationship with each other. We're expecting UCAD to go shorter, but we'd like to see the model play out. How? We'd like to see the model touch the DR before it continues lower. So bringing your point of attention to at least some things that I looked like they would potentially be playing out. We hit 2 standards off the flout, or 1 full standard, 2 half standards off the flout. Like to see CAD touch the 0% trigger of the ADR, then we'd have a lot of room in the way of backstops. We have this invalidation point, which again, when I look at the model and when I see it tick there on that yellow line, is what I want to see as my max retracement. Then for me, we're starting to play out the model. Something else that's nice to look at is always coming back to here. Now the rule set in the model that you've been taught, clearly you would wait for a retracement back to the 0 trigger. This level is a serious interest to me though, within the if-then statements of projecting price. This level is also very interesting to me within the if-then statements of price. Still like to see it hit. Looking at the dollar, the euro dollar, a high was formed, a low was formed, and we want to see a close up above the high for some bullish momentum on this very, very low time frame in analysis of institutional order flow coming from a high time frame. So instead of being focused on a 4-hour, a 1-hour, a 90-minute, or a 30, we're applying market structure and logic to a very low time frame within our if-then statements. Looking at some questions. This is my first day.